What's up, you guys? Welcome to a brand new video. And today I want to share with you a trade idea that I did on this company right here, Biogen. And it's an excellent trading idea for a very volatile stock that just isn't moving. Well, how does that make any sense? If it's volatile, should it be going up and down like a roller coaster, right? Well, sort of. This stock had a huge move up in early November of last year, and just a day or two later, it dropped like a brick. And since then, it's been trading flat like a pancake. And I'll explain why in just a moment. The volatility that I'm referring to, however, that relates to the options premiums. Even though the stock is flat, there's a pending news event that has really created a lot of volatility in the options prices. Since volatility is so high, that pretty much eliminates any of the option buying strategies because it's going to cost you a fortune to buy these options. And I'll show you why in a moment as well. But since our main strategy is selling options, we can make a very nice profit on this thing right here, even though the stock isn't moving. And that's because we're going to be collecting that inflated options premium. So I was researching this company because I noticed that Morningstar gave them a very favorable 4-star valuation rating. They believe that this stock is worth somewhere around $350 per share, even though it's currently trading in the mid 270s. So that got my attention, and I started to research it myself. And in this market environment that we're in right now, it's very hard to find great companies at great prices. So I wanted to see if, in fact, it is still a great business that's trading at a bargain price. So I want to share with you something real quick. What you see right here, this is Biogen, ticker symbol is BIIB. Morningstar gives their stock ratings a 1 through 5 rating, 1 being stocks that are overvalued, and 5 being stocks that they believe are very undervalued. So this right here is a 4-star rated stock. It's currently trading at $277, and they believe the stock should be $350 a share. So there's some opportunity to make some money if indeed this valuation is correct, and if this stock is a great company without much risk in the near term. So I'm going to come over here to Morningstar. And Morningstar, where did you go? There you are. All right, so I want to look at some of the numbers just to see if this company is moving in the right direction and if I should dig even deeper into this company. So I want to take a look at their revenue. And as we see in 2011, they had $5 billion in revenue, then 5.5, then 6.9 billion, 9.7, 10, 11, 12, 13, 14. Then it came down to 13 billion in 2020, and it's even lower now, trailing 12 months. Operating income, the same thing. It's moving very nicely from 2011 to 2012, went from 1.7 to 1.8 billion, 2.4, 3.9, and it's moving nicely. Small little hiccup right here in 2017, but then it bounced up in 2018, went from 5.5 to 6 billion, 6 billion to 7 billion, and then 2020, it dropped again. And we see that with their net income. It's moving nicely. It had a little hiccup once again in 2017, but it recovered from that. Coming up, and then 2020. Seems like something happened in 2020. We need to find out what that is. Earnings per share, same thing, moving up real nicely, and then it drops in 2020. Book value per share, going up real nicely, consistently, and then it drops in 2020. Operating cash flow, real nice, and then it drops in 2020. Free cash flow, I can go on and on. Now, let me just show you a couple other things too. So here we see return on assets, nicely, high teens, low 20s. Right here, 2010 again, or 2017, there was a bump in the road, and then it's back down again. 2020, trailing 12 months is only 12%. Same thing with return on equity and return on invested capital. So I want to find out what is going on with this company, because obviously the company looks great. Everything's been growing nicely. It just has something going on recently. Let me close out of Morningstar, and I want to read something that I found on Value Line. So Value Line gives a nice report with some of their analyst opinions. Right down here, we see that the company's financial strength is an A-rated company. Their earnings predictability is pretty good at 80%, 80 out of 100. Their price growth persistence and the price stability is not too good. So it does jump around a lot. Not recently, but I'll get to that. So Biogen has all of its eggs in one basket. The company's fortunes are riding solely on this drug right here, and I'm not even going to try to pronounce it. So I'm going to mess that up. It's long-suffering Alzheimer's drug. On November 9th, the stock price collapsed after an FDA advisory committee comprising of 11 scientists recommended that the FDA not approve this drug by 10 votes to 1. Now, let me show you something else. And that is going to bring you to this right here. This is the chart for Biogen, BIIB. Take a look at this chart. Not pretty over here, but not bad. But then all of a sudden, November 9th, it goes all the way up, November 8th, whatever day that is. And then, boom, comes collapsing back down. That is November 9th, right in here. And that is because of this event right here. So the FDA, they're due to make a decision on that drug on March 7th. They don't need to take the advisory committee's opinion or recommendation. They often do, but they don't need to. They were going to make a decision on what to do with this drug on March 7th. That has since been postponed to June 7th. Very important date to keep in mind. So as we see here, a lot of problems or a lot of concerns, a lot of question marks with this drug right here, and it's going to be postponed whether or not they're going to pass this drug or not on June 7th. So coming back down here to this valuation, I did a couple other valuations on the stock to see if in fact it is at a discount, and it's at a slight discount. Morningstar's fair value price, which we see right here at 350, I think that's kind of optimistic. But even if that was its true intrinsic value, if the true price should be 350, I don't want to buy this stock right now because there's too much of a question mark. So the couple dates I want you to keep in mind right here, June 7th, which we just saw. This thing can go either way. If they pass it, the stock's going to skyrocket. But if they don't pass it, that thing's going to drop like a brick as it did back on November 9th. So how can we take advantage of that right there? Brings me to this next date that we see, May 21st. That is the trade that I'm about to share with you. And March 21st is when that trade is going to expire. So I want to profit off the pending news event and the corresponding volatility associated with that event. But I don't want to be in that position anywhere near the June 7th date. So we're placing a trade that will expire well before that date, and the expiration that we're going to select is May 21st. What we're seeing right here in this chart, this is an excellent visual of why this can be an amazing trade. First, the current trend is very flat, as you see right here. It's flat as a pancake right now. Next, we see that the historical volatility is very low. It's at 0.27. And then below that, we see implied volatility. And that is going through the roof right now. That's at 0.74. So the current volatility right now is almost 3 times that of historical levels. This means the option prices are sky high right now, as you see right here. Volatility is going way up, 0.74 compared to history, 0.27, on a stock that's absolutely flat. So we're collecting a ton of premium right now from the options compared to normal levels without the roller coaster ride of a volatile stock. Now I want to show you the mechanics of how this trade works. The current stock price was actually $269 when I placed it last week, and right now it's $277, so it's gone up a little bit. First, we're going to place a bull put spread, and that's going to expire pretty soon on May 21st. And what we're going to do is we're going to sell a short put at the $235 strike price, and then for protection, we're going to buy a long put at the $230 strike price, and that's going to give us a net credit of $20 per contract. Now what we see here is this is the short strike. So this is the price that's closest to the underlying stock price. And this is a screenshot of when I placed a trade last week. So because this is closer to the underlying stock price, the option premium is higher, and we're collecting this. And for protection, we're buying the $230 strike price. It's further out of the money. That's why it's cheaper. And since we're paying something that costs less, that is going to give us a net credit of 20 cents per share. And since one contract represents 100 shares, we're collecting $20 for this one trade right here. $20 isn't a lot, but usually when you place these trades, you're going to do several contracts, not just one. But for example purposes, we're going to use just one contract. We set up the trade so we have a 90% probability on this trade of closing what's called OTM, closing out of the money. And that's what we want. That just means that the stock stayed away from our short strike price and we were not assigned. As long as Biogen stays above 235, this side of the trade is a winner. The next part of the trade is called a bear call spread. An iron condor consists of both a bull put spread and a bear call spread. So what we did right here, we selected the same expiration, so May 21st of this year, a couple weeks away, and we're going to sell a short call with a strike price at 315. And for protection, if the stock goes anywhere above 320, we're protected because we bought the long call at 320, and that's going to net us $30 per contract. And we can see that right here. So this is what we're collecting, and this is what we are paying. That will net us 30 cents per share or $30 per contract. This trade also has a 90% probability of expiring out of the money. So as long as Biogen stays below 315, this side of the trade is a winner. And then this is a chart of where Biogen is right now. And these inner lines right here, this represents support and this represents resistance. So going back to the beginning of this year, the stock's been in a pretty flat trading pattern, trading between 252 and 285. And these outer lines is where we place the short strike prices for this trade. So as long as Biogen stays above 235, which is this line right here, and as long as Biogen stays below this line right here of 315, we're going to have a nice double-digit winner in just 21 days from the start of this trade. And as of today, when I'm recording this video, there's only 14 days left. So the max risk is $5 minus the credit that we receive. This is a $5 spread. 235 and 230 on the put side, and 315 and 320 on the call side. Now, from a margin requirement standpoint, the stock can't close up and below those two strike prices, so you can only lose on one side of the trade. Therefore, the margin requirement is just for one side of that trade, one leg, either the bull put or the bear call, it doesn't matter. So the margin requirement is going to be $5 minus the credit that we receive, which is 50 cents. So the maximum risk is $4.50 per share or $450 per contract, which is also your margin requirement. You have to have $450 in your account to place this trade. The rate of return is the credit we received at 50 cents divided by the max risk, and that equals 11.1%. And the potential annualized rate of return is actually 193%. So how do we figure that out? And is that a guaranteed return? What we do is we divide 365 by the number of days that we're in that trade. And in this example, it's a 21-day trade. And that is 17.24, I believe. And we multiply that by the rate of return of 11%. And that gives us what our potential annualized rate of return would be if we were able to collect 50 cents every rolling 21 days throughout the year. So it's not an exact rate of return that we're earning, but it is to help you compare what this trade could look like over the long term being the year, it's actually not long term, versus what another trade could look like. So annualized out to 193%, but the actual rate of return, if this turns out to be a winner, is 11.1%. And then we also have a margin of safety. When we place a trade, we were 13% away on the bull put side and 16% away on the bear call side. The probability of this thing expiring out of the money, which is very important, is 90%. So this is a very high probability trade, high probability of success. And then another thing that's very important is the days until expiration. There's only 14 days left, and that includes the weekends. So as a seller of options, time decay works in our favor. This thing is working for us on the weekends when the market's not even open. If we are a buyer of options, those are 2 extra days, Saturday and Sunday, actually 2 weeks, that's 4 days that we're in the trade, and we want this thing to work in our favor, but the market's not even open those days, so it could work against us. And time decay works against option buyers. So a side note here regarding the probability of expiring out of the money. This is based on a mathematical formula called the Black-Scholes model. That takes into consideration many factors, and this will help us determine where to place our trades for the most return and the least amount of risk. However, the Black-Scholes model, or the probability of OTM, does not take into consideration the charts that we use to our advantage. Is this in an uptrend? Is it in a flat trend? Is it in a downtrend? Are we looking at some of the indicators such as the moving average or the stochastics, anything like that? This can help our percentages of success increase, but we're also going to use a stop loss. Therefore, we're going to get stopped out early on certain occasions, and that will lower our chances of success based on these probabilities. The reason we use a stop loss is to protect our capital. That being said, the probability of expiring out of the money is a guide on where to place your trades for the optimal results based on your goals and your risk tolerance, but it's not a guarantee that the success rate will be 90% or whatever probability OTM that you decide you want to use. It could be 80 if that's what you want. If you want 80% probability, Your rate of return is going to be higher, but so is your risk. Also, since we are using a stop loss, which is set at the short strike prices, in this example, that would be 315 and 235, then the max risk is half of the spread. Since this is a $5 spread, the max risk is actually $2.50 minus the credit received, not $5 minus the credit received. So we are risking $2 to make 50 cents, which is a lot better than what you see up here where we're making 50 cents, but we're risking $4.50. Now, I want this to be closer to a $1 risk for a $1 return, but we would need to be closer to the underlying stock price, and we don't need to take that extra risk from a probability out of the money standpoint on this trade. So how are we going to make money on this? There's a couple different ways we can do so, which is interesting because when you're buying options, you have to be right in the direction and the time frame. So there's two things you have to be right on just to make money. Well, when you're a seller of options, those things don't have to work in your favor. You can be wrong, it's not too wrong. Volatility can go down. Time decay can work in your favor. So there's a couple ways we're going to make money on this trade. Number one, by selling an option with sky high volatility, then we can close it after volatility goes back down to normal levels. And if that were to happen, we can close this thing out well before expiration and keep most of the profit. Since this particular trade's volatile because of a news event happening on June 7th, and this thing's expiring on May 21st, that's probably not going to happen. But for future reference, when you do trades where volatility is high, you can close it out if volatility comes back down to normal levels while you're still in the trade. Another thing is time decay. As options gets closer to expiration, the time value goes way down each and every day. Since time decay is working for us, we can also close this thing out prior to expiration and still keep most of the profit. So what I want to show you here, this is a kind of a blurry chart, but it's a chart on time decay nonetheless. If we are 9 months away from expiration, time decay is moving very, very slow, not a lot. As an option buyer, you have 9 months for your prediction to be correct. And as an option seller, we're going to be in this thing for 9 months. So time decay is really not working for us too much. And as we get closer to expiration, the option buyer has less and less time for their prediction to be correct. And time decay is not working in their favor. As an option seller, which is what we are right now doing the Iron Condor, that is working in our favor. And as each date passes and as we get closer and closer to options expiration date, that's going to help us out on this trade. And since we're in this trade for 21 days and there's only 14 days left, look what happens the last couple days until expiration, or last couple weeks actually. This thing drops like a brick. So we can actually close this thing out probably next week, 7 days before expiration, and still be able to keep a lot of the profit. Another way we can make a profit on this, and the main way we're going to make a profit on this trade right here, is if the stock stays in a flat trading pattern. So as long as Biogen does not go above 315, which was 16% margin of safety when we place the trade, or as long as it does not drop below 235 or a 13% margin of safety, we're going to be able to keep that entire profit, 11%. We are able to use a news event which could pay us a double-digit profit in just a few short weeks, and we don't even have to be right in which way the stock moves. It can go up and we win. It just can't go above $315. It can also go down and we can win, as long as it does not go down below $235 a share. And it could stay absolutely flat, which it has in the last 7 days that I've been in the trade and the last couple months, and we can still win. So we can make money if the stock goes up, goes down, or if it trades absolutely flat. So this video will probably make a lot of sense to those of you who understand how options work, and for those of you who have placed these types of trades previously. For those of you who are new to this, some of these words and ideas may be new to you, but don't worry, because it's real easy to learn once you practice this a few times. And that's what we teach. We teach you how to do this. We teach you how to do this using a paper trading platform. So if you do make a mistake, it's not going to cost you any money. And if you want to learn more about options trading and how to place these types of trades, book a call with me, and I'll let you know when our next group coaching program is. Or if you prefer an independent style of learning where you just learn in your own time without the help of any of the coaches, then the link above right here will take you right to our options trading bootcamp course, where we teach this strategy and many other income generating trade ideas. So here's a link right here to book a call with me, and here's a link right here to the option trading bootcamp. So let me just click on this real quick. Book a call. I'm just going to ask you to answer a couple questions, and then schedule time that's convenient for you. Or if you just go right to our website, products, here's my goofy looking face, And then right down here is the option trading bootcamp course right here. And then the last thing I want to show you is, once you get access to the group coaching or the options trading bootcamp course, here's where you'll be able to access all the information. I just want to show you what you're going to get. Here's our members area, and the options trading bootcamp course is right here. So you have a lot of courses here, the basics of options, trading levels that you need to get approved for before you do any of these trades. Here we talk about the Greek, such as the time decay, some of the trading strategies, the bull put spread, the bear call spread, and a bunch of others, how to fix a losing trade, how to lower your cost basis on stocks that you do own. These are my two favorite, the fast track to retirement and financial freedom. Once you know how to generate an income trading options, retirement is definitely not as far off as you probably think, because you can make a nice income trading options conservatively, and you don't even need $1 million portfolio or anywhere near that to be able to live off of a nice income. How to fund your IRA with other people's money. And then I'm constantly adding more sections to this. And then you also get access to the course workbook, some of the trading journals, and the trading rules. And for those of you who want access to some of the other things like our Trade Room Live, that's all here as well. So if you have any questions, please comment below, book a call with me, and I'd be happy to answer any questions you do have about options trading or value investing or investing in general. So that's it for this video. I hope you'll like it. I hope you found it informative, and hope you start using this strategy, because it is a very, very good way to make a profit on stocks, and you don't even need to be right in which direction this thing's going to move. So this is one of my favorite trades right here. So that's it. Thanks again for watching. Please don't forget to hit the subscribe button, turn on notifications so you don't miss any of our upcoming videos, and I will see you next week in our next video. I got a great one coming called the buy right combo trade. So that's it, guys. I'll see you soon. Take care.